Today I'm going to talk about a DCF, or discounted cash flow model, used to value a stock. And the example I'm going to use is a valuation of equity of Walmart. If you're looking for this model, it's going to be at my website on Google Sites, Lou Gaddis, so you can use that address. Go to links, or I'm sorry, files, and you can pull up the equity valuation file. File looks like this, and I'll give you an overview of the model. What the model does is it first forecasts one number, which is this number right here. This is the free cash flows for the firm. To calculate that, we're going to get revenues, operating profits, tax rates, and net reinvestment rates for the firm. Those will drive your free cash flows. Then over here, I'll estimate the discount rate for the firm, the weighted average cost of capital. So we're going to get data on number of shares and debt and their cash and market cap and their beta. Use that to calculate this number here, the weighted average cost of capital, and that'll be the discount rate to discount future free cash flows. So here I have a simple perpetual constant growth DCF model. So it takes the free cash flow that I'm estimating, assuming to be 1 year from now. I then estimate the growth rate of free cash flows forever. So this part only works for firms that are already at a mature stage and you expect to grow, say, no greater than, say, the 10-year treasury rate, which would be a good estimate or a reasonable estimate for the long-term growth of the economy. Calculate the present value of all cash flows, assuming the first one is here, 14 billion. That 14 billion grows at 1.93% forever, and you want to discount that at 6.11%. You get the total value of the firm, subtract out debt, divide by number of shares, and you get an equity price. I also have a section of the spreadsheet over here. This section here just simply calculates the reinvestment in the firm. And then this section here is for valuing firms that are growing faster than, say, the 10-year treasury rate, at least for your estimate of the next few years. So we'll talk about that. So what I'd like to do is walk you through the model, some of the assumptions, show you some of the sources that I use for this data. First thing, I want to go to Yahoo Finance and pick up the stock price, $87 or $88. And then what I'm going to use is I'm going to go to their income statement and balance sheet and cash flow statement. They're down here to the left. Again, this is Yahoo Finance. You just go to finance.yahoo.com, type in a symbol, say Walmart. You can get the stock price on the front page. And then we can go to, say, the income statement. And we can get the last 3 years, 12, 13, and 14, total revenues. So 446 billion, 468 billion, 476 billion. I'll go ahead and put those numbers in here in my spreadsheet. So you can see I'm just entering it in. The one thing I'm going to use, the formats I'm going to use, is whenever you see this color here, that's going to be Excel's cell style you use for inputs. So all these cells require you to put a value in. I have some defaults in some of them, but you in general have to pick up those values. So again, I'm going to get in my total revenues, 2012, 13, 14. I'm then going to put the operating profits in. $26.8 million, 27.7 billion, and 26.491 billion. I'm then going to estimate their taxes. So using the financial statements, I'm going to take their total taxes, say in this first year, or most recent year, 2014, they paid 8.1 billion in taxes. Income before taxes of 24.6 billion. So I'm going to write that in the spreadsheet for 2014 and get an effective tax rate in 2014, 13, and 12. So they pay about 31, 32, 33% in taxes. And then I make some calculations. This color cell here means calculations. So the calculations are my revenue, 3 years of actuals. 2013 grew at 4.9%. 2014 grew at 1.7%. I'm just going to use a simple formula here. You can type over whatever you want. If you think it's going to grow at last year's growth rate, you can type it in. I have a simple formula just to be conservative here. I'm going to use either last year's growth rate or an average of the last 2 years' growth rate. So the average would be about 3%, but being a conservative valuation, I'll just put the minimum of 1.7 or the average of the two. But again, this is your job as a forecaster, is to forecast what you think growth will be in next year. And that'll be a function of both the growth of the economy. So if the economy is growing at 2%, and you think that Walmart will increase sales somehow, either in the U.S. or other countries, you might have a growth greater than that. Now I make a calculation here, the operating profit margin. Historically, I just look at as a ratio. So in 2013, they made 27 billion divided by 468 billion. So they make about 5.9 to 5.6% of their revenue winds up as profits. All right, so the rest would be cost of goods sold and administration. So I'm going to then forecast what net operating or operating profit margin will be, and I'll use the same logic. You can see it's going to be somewhere around 5.6, 5.9 next year. I'll just use the minimum of the average or last year's. Again, this is up to you. You don't have to use these. Then I can calculate the operating profits, which will just be the revenue times the operating profit margin. There's the tax rate. If I take my operating profit minus tax rates, I have my net operating profit after tax, or NOPAT. So in 2015, I'm forecasting that they'll have 18.3 billion of profits after taxes. And the last thing I want to do is calculate something called my net reinvestment. So of their 18 billion, they have to use much of that money, or a percentage of that money, to say upgrade stores or open new stores or handle replace equipment and computers. I'm going to say that net cost is going to be 21% of profits, which is what they've been running. They ran 20% of profits in 2013 and 21% in 2014. I'll take a conservative by taking the higher number, right? If you invest more into the firm, your profit's going to be lower. And that's going to be my estimate of free cash flows. Let me just walk you through how I got this net reinvestment. How much are the profits they have to plow back into the business? In 2013, they had 13 billion of capital expenditures, or we call CapEx. If I go to my Yahoo Finance statement of cash flows, CapEx, that would include, say, purchasing of new buildings or refurbishing of new buildings, buying of new equipment. All right, so any kind of capital goods that they're purchasing, goods in which are used for long term and not used for immediate sale. However, they had 8.9 billion of depreciation. So I'm going to wind up to calculate their total reinvestment of, say, 4 billion that year. They had 13 billion of CapEx, but they had 8 billion of depreciation. Now, depreciation is really the accounting recognition of past capital expenditures. So if I were to not add this back, all right, I would be double counting my expenses, because some of their profits have already been reduced because of depreciation expense. So what I need to do is add it back here, this 8 billion, and then subtract the real cost, cash cost of capital expenditures in 2014. And then I have changes in non-cash working capital. So working capital includes receivables, payables, inventories. So we have non-cash working capital. So I calculate that it hasn't changed that much, down 437 million. So that's the last thing. If you're building up inventories, say, that would be another cost or a reinvestment in the firm. So bottom line, they had a net reinvestment of 3.8 billion of profits in 2014, which is about the same in 2013. And as a percentage of operating profits, that's 20% of operating profits. And again, the way to think about that $4 billion is they spent $13 billion in 2014 for new equipment. I'm going to net that against the depreciation expense from prior years that are already included in profits, and that gives me my net reinvestment of $3.8 billion. So all of this work is really to get one number, which is $14 billion. And then I have estimates of what's been happening with those free cash flows over time. And my estimate is that the free cash flow will grow by 1.7% from 2014, which is also the growth in sales. It doesn't always work out to be that way, but that's because the constant capital or constant free cash flow assumptions of CapEx and reinvestment rates. So all this work is for this $14 billion. That's my estimate of free cash flows for Walmart in 2014. Now I'm going to go back to Yahoo Finance, and I'm going to pick up some data, because I want to do is I need to use this as my estimate of free cash flows next year, get an assumption of how that's going to grow, and take the present value of future free cash flows. And the discount rate I'm going to use to take the present value of cash flows is called the weighted average cost of capital. So I'm going to go to Key Statistics in Yahoo Finance, and I'm going to pick up a number of numbers, or a number of items. I'm going to pick up their market cap, $282 billion. Now be careful, data's in billions here. Try not to mix up millions and billions and thousands, so I try to make this spreadsheet all in millions over here. So they have a market cap, that's the total value of their stock, of $282 billion. I'll put that there. I'm not going to use their beta from Yahoo Finance. I'm going to get another source. I'm going to put in their $6.7 billion of cash, their total debt of $55 billion, and number of shares outstanding of 3.22 billion. So that'll give me my shares, 3.2 billion shares, total debt, cash, market cap. Tax rate, we need that for weighted average cost of capital. I'll just use that for my estimate on free cash flows. To get weighted average cost of capital, what is this going to be? A weighted average of their debt, expected debt costs, and their stock equity cost. The cost of debt, I am going to go to Morningstar and look at some of their long-term bonds and see what yields are on their long-term bonds. So I'll go to a Morningstar website. So you can go to morningstar.com, or here's the actual address I used up here. Find the stock, and then I'll look at some of the stock's debt. So I'm looking for some fixed rate debt of long-term duration. So here's a 2038 bond, 2035 bond, 2037 bond. Oh, about 3.5, 3.6% is the yield to maturity. So when Walmart borrows money, he has to borrow at 3.6%. So I'll put that in my spreadsheet. Actually, I put in 3.55. Now the cost, so debt holders are requiring 3.6%. Now the question is, what would equity holders use? And I'm going to use the capital asset pricing model, CAPM. CAPM says the cost of equity is going to be equal to a risk-free rate plus a beta, which is a measure of the risk of the firm or the stock, times a market risk premium, which is the average return on stocks over bonds. So the first thing I'll use is the beta, but I generally don't use the betas you find on the websites because they change a lot over time, especially as the firm matures. So what I'm going to go to is DeModern has a website at Stern School at NYU. And what I use is an average beta for their industry, because I assume that the industry beta is going to be much more stable. So I'm going to look for, say, unlevered beta corrected for cash. And I'm going to look for retail, general. And looks like, on average, general retailers have a beta of 0.85 if they have no debt. And that's what it means to have an unlevered beta. So I'm going to put that 0.85 beta in. The next part for CAPM, so I now have the treasury rate I'm going to use for the risk-free rate. Beta I'm going to get from DeModern. And then I need a market risk premium. This is the average expected return of the stock market over the long-term bond market. I'm also going to go to DeModern and go to another one of his websites, the implied equity risk premium for the U.S. market. And I'm going to look for the implied premium for free cash flows. Implied premium free cash flows. I'll go to his latest year. And his latest estimate is the risk premium is 5.78%. So I'll type that in as the average return on stocks over bonds in the market. And then can calculate the percentage of Walmart that's financed with equity, which would be my market cap of equity divided by debt and equity. My percent in debt, which is 1 minus that. And then I'm going to estimate what Walmart's beta would be given its debt structure. So, again, what I said is I picked up this beta, 0.85. That's an average beta of a firm that has no debt in the retail sector. Walmart has debt, has 16% debt and 84% equity, and a formula we get used to lever up the beta. This will give us the beta of a retailer that has the debt equity ratio of Walmart. So that gives me a levered beta of 0.96. There's my 10-year treasury from Yahoo Finance bonds. So I can just go to Yahoo Finance, look up the 10-year treasury. Current yield's about 180, 190. That allows me to do the CAPM calculation. 10-year treasury plus my beta. Oops, I need to switch that to my levered beta. All right, so that's my levered beta times my rate. So I can now calculate weighted average cost of capital. It's using these 84% and 16%. It takes a weighted average of the cost of equity and Walmart's cost of debt, and that gives me 665. So now I have a discount rate to calculate the present value of future cash flows for Walmart. My future cash flow is $14 billion. I'm going to assume that grows at some constant rate. So this is a very important assumption right here. It's terminal growth. So what this is saying is if next year's free cash flows are $14 billion, it's asking, or it's telling you what it'll grow at forever. So I'm going to assume some level of growth for the end of time for Walmart. Now, a conservative estimate would be just to plug in the 10-year treasury rate. 10-year treasury rate, I've heard, is a good estimate for the long-term growth of the economy. So we think the U.S. economy might grow at about 1.9% forever, nominal growth. So I'll just assume Walmart grows at that same rate. Now, you could say it grows a little bit faster. I would not do that. So generally, I'm never going to put in a growth rate greater than the 10-year treasury. However, you could say Walmart might start losing ground to, say, Target, so I might put in zero growth. But I'll go ahead and keep 1.93, so Walmart just keeps the same growth as the economy. And then I can use a growth perpetuity formula that the present value of $14 billion received next year, and that $14 billion growing at 1.93% forever, I can use a present value of growth perpetuity formula, which is the cash flow over the discount rate minus G. That tells me that I should pay $306 billion today. If someone promised to pay me $14 billion next year, then that cash flow would grow at 1.9% forever, and I wanted it to earn a rate of return of 6.65%. So this gives me an estimate of the total firm value of Walmart. Now this is total firm value, meaning cash flows or value of debt and equity of the firm, total assets. I'll subtract out the net debt of Walmart, which would be their debt minus cash. So they have $49 billion of debt over the value of their cash. So the value of equity would be your total value of the firm minus the value of debt. So I think the stock should be worth $257 billion. Divide by my 3 billion shares. And that says that my intrinsic share value for Walmart is about $79. The current share price of Walmart from Yahoo Finance is $88. So it looks like it is right now a bit overvalued. I think it's only worth 79, but the share price is 88, which is about a 9% overvalued amount. So you could use this just to value a firm that is in constant growth at this point, a very mature firm. You'll notice here I have another, this 79 shows up here too, because I have another set of growth assumptions here that you could estimate growth for the next, say, 10 years. And then assume it grows at some constant rate. Now here I just have it growing at 1.93% every year. So you can see my free cash flows are growing. My free cash flows are growing at 1.93% every year. So 10 years from now, those cash flows will be 17 billion. And I take the present value of those cash flows and then use the growth perpetuity formula here to get total value of the firm, subtract out debt, and divide by shares. And that gives me the same value because this 1.93 is the same as this 1.93 here. However, I've created this section for any firm that you think may grow at an abnormal rate, meaning above the 10-year treasury over the next 10 years. So say you think, due to, say, Walmart's China strategy, that it could grow at 5% next year, maintain 5% for a few years, then go to 4, then maybe 3, and 2, and 1, and do it like that. Now, that would tell me that Walmart's worth $80 a share. All right, now these two numbers don't give the same value because this one's assuming it grows at 1.9% forever. This one is assuming that it's going to grow above that rate for a while. Okay, so this is our model. I'll change this back to 1.9 to get those numbers to tie back out to each other. And again, I would use this for any firm I'm valuing that's growing, say, faster than 3% next year. And I'll just forecast annual growth until I get to a level that's below the 10-year treasury. So that's the DCF model for valuing cash flows. I did one other thing with the model. One number down here, I took the price of the stock divided by cash flow per share. And Walmart is selling for 19.6 times their cash flow per share. So this is an example of something called a price multiple. So one way to look at a value of firm, since we have so many assumptions in this, is to maybe look for firms in, say, a similar industry. I would compare, say, Target and Costco and Walmart and several others. And maybe what I would look for is a firm, I look to buy maybe the firm that has the lowest price multiple, cash flow, or price to cash flow. That means it's cheap, but then would also have underlying good fundamentals, which might be has above average growth or lower risk or better strategies, or insiders are buying, or any other type of or characteristic of the stock you think is beneficial. I would look for low multiple and good underlying fundamentals. So that's my DCF model.